Our next speaker is Associate Professor Susan St John, who is a co-director of the Retirement Policy and Research Centre at the Business School at the University of Auckland. And she has been working in the field of super policy and pensions and annuities since the 80s, and she's currently working, among a number of other things, on the topic of decumulation, approaches that could resolve market failures in the annuities market and the long-term care insurance market. Could you please welcome Susan St John?
Thank you very much. I've titled, well, I thought I had, titled it "Why No Annuities?" It's a bit like asking why the pub has no beer, in my view. This is actually a really serious issue. We don't have annuities. Academics love to talk about the annuity puzzle. It's the idea that we know that annuities are very good for us, and why don't we have them? And so conference after conference, we'll talk about the annuity puzzle. So if we think about where we are at the moment, I would argue that we have policy incoherence. So we've got New Zealand Super, and we'd have to describe that as the perfect annuity. And in part, I guess that explains why we don't have a strong annuities culture. So there it is. It's gender neutral, it's tied into wages, inflation and wages, provides basic longevity insurance, a brilliant, brilliant product. But beyond that, particularly for middle income people, there is nothing to help run down lump sums over a long period or an uncertain period of retirement. And so what can happen is that lump sums are used up too quickly, obviously KiwiSaver, but also other saving. And then there's the illiquid home. And something that has been mentioned today, and I think it's really, really important to bear in mind, and that is the risk of expensive health care, and particularly the need for long-term care costs. I think it was John Brognan that mentioned that. Now, we know very little about what people with annuities actually think of them. We haven't got many people with annuities. Milton has indicated very clearly that annuities don't appear to be popular. So I thought it would be helpful to just take an example of one from my own family. Here is my father, who retired at 58. He's now 97. He's had a public sector pension over 40 years. Started out being small, but it's inflation linked, and so it's doubled several times. So this particular annuity, get the next bit up, is protecting him from his longevity risk. It's protecting him from inflation, and now, although he looks fit and well there, he's actually now in a rest home. And so in order to meet the end of life care costs, it's extremely valuable to have an ongoing pension that, together with New Zealand Super, can be used to fund the costs of long-term care. So if you would ask him, was it a good idea? He didn't take any of his saving as a capital sum. He annuitised the whole lot. There was a choice at the time. Of course, he would say it's been absolutely brilliant, and he has had a brilliant retirement. He has not had to worry about how to invest or what's happening to the investment and so forth. So I think we do underestimate the values of annuities if we just look at the market and we think about the way that people don't seem to value them. Having some difficulty here. If we think about those people with annuities right now in retirement, then they're a very rare thing. Coverage under superannuation schemes has declined, as you can see from this graphic, from the early 90s down to less than 10% of the workforce today, and of course what is happening is schemes are closing and KiwiSaver is coming in to take the place. But these traditional schemes, coverage as low as it was, is still only about, or less than 2% defined benefit schemes that will give some sort of pension. And of course fewer again of those will have an inflation-proofed pension. So if we look at those pensions actually in payment, there's about 1 in 10 people over the age of 65 that have some kind of pension in payment. So of those, the bulk of those are from the government super fund, but when we look at the size of those pensions in payment, if we look at the distribution of the size of annuities coming out of those funds, then we see that actually there is a huge tail. At the top end, there's large ones being paid, obviously the politicians, etc. But the bulk of people, 50%, have less than $12,500. So of those who are actually getting an annuity, the bulk of them are small, and aside from the government superannuation fund, not likely to be inflation-proofed. Here we have a picture that somebody sent me when they knew that I was working on decumulation to sum up some work that I had done. And I thought it actually tells quite a good story. So without proper decumulation products, you've got maybe the widow, don't like to be sexist about this, but it looks like a widow trying to look after her nest egg and probably worrying herself to death. And there's the male over there, and the umbrella's already got a crack in his nest egg, and there's a few birds hovering around to peck a few more holes. And down at the bottom, you've got the man with the small nest egg with his fishing rod off to try to invest that nest egg to try to make a bit extra. So it's a miserable prospect. And annuities are a brilliant solution. So why no annuities? Well, first of all, I would argue it's not through lack of demand. If we look at some research that's come out of Australia, it appears that people are interested in the idea of annuities, if only you don't call them annuities. So if you say to somebody, would you exchange a lump sum of, say, $100,000 for a given amount that will go on every year for as long as you live, then people are interested. And they see the value of that, particularly if it is inflation-proofed. So I think we are dismissing this idea of lack of demand. We're putting too much emphasis on this idea of lack of demand. And I think women in particular, on their own, just want their savings taken care of, and they want something regular that they can rely on. New Zealand is a perfect case study, I would argue, for what happens when you do not have any state support at all. As we've just heard, the market for life annuities disappears. It's the classic example of what happens. And we heard all about the problems for the providers of annuities in an unsupported environment. So the first conclusion is that unsupported, if there's no intervention whatsoever, there will be no life annuities. And I think we do have to get hold of that concept. There are social benefits from annuities, I would argue, that can justify government intervention. And I don't think these are well articulated or well understood. Now, from my father's point of view, he's had a really good retirement. He hasn't had to worry. He's had an annuity coming in, and now he doesn't have to worry about paying for long-term care. But it's also an advantage from society's point of view. And what is happening with annuities is that you're spreading the costs of ageing more equitably, making those older and wealthier pay a greater share. The ones that live longest are subsidised by those who die earlier. And in turn, that puts less pressure on the young. So there are some intergenerational issues for annuities that we need to understand if we're going to argue, as I think we have to, for government to take a role. Government will save costs where there is ongoing money to pay for long-term care. That should be reasonably obvious. And maybe some intervention in the annuities market could be quid pro quo, so that full amount of the annuity would be used for long-term care, or maybe the annuity itself would build in some form of long-term care insurance. So I would argue that in New Zealand we missed the boat with KiwiSaver. When we started to subsidise private saving, the KiwiSaver program, we should have at that point considered making annuitisation a compulsory feature. I would argue that we have missed the boat. We do have a voluntary regime. People have joined KiwiSaver under one set of rules. We can't turn around and make another set of rules. However, I think that because we've had few tax favours for this accumulation phase, that there is a case for looking at a subsidisation of the decumulation phase. So voluntary annuitisation of KiwiSaver, together with other savings, could be subsidised in some way. Maybe it could be to provide an annuity of some maximum, say, for example, $10,000 per annum. And here is a suggestion that we're working on at the Retirement Saving Policy Centre. An annuity of a maximum value $10,000 per annum, inflation adjusted, gender neutral, maybe a built-in guarantee, maybe that could be priced into this. The government taking a strong role, I would argue as a provider, at least in the first instance, in some Crown entity, and carrying the longevity risk and the inflation risk, and building in a long-term care rider. Now, we're quite fortunate in New Zealand in that the arrangements for long-term care are already perfect for an insurance product because we have a capped fee. You only pay up to $46,000 as a capped per annum fee for long-term care. And so it's easy enough to design a long-term care rider that you could build into an annuity product. Now, I'm not pretending that pricing such an annuity is simple. It's not, but at least if you've got the government doing it, it doesn't have to be actuarially perfect. And what we've done in the centre is some simplistic pricing based on probabilities of living to a given age and the probabilities of being in care. Assuming no overheads, if the government is doing it, it can be done in a very cost-effective way, assuming a real rate of interest of 2%, and assuming that an annuity will treble on being admitted to residential long-term care. So if you've got your $10,000 annuity, you need long-term care, that goes up to $30,000. Together with your New Zealand super, you can pay the capped fee. Some tentative costings of this, if we looked at just providing a straight annuity of $10,000, given those very strong assumptions that I listed before, then it would cost in the vicinity of $144,000. If we build in an annuity, if we build in a long-term care rider so that you had that trebling on being admitted to long-term care, another $13,300. So $157,700. Now, these are just ballpark figures. And of course, other combinations could be investigated, and you could build in a guarantee for 10 years or 5 years or whatever you want to do. I want to finish by saying that time is actually running out. If we're going to look at any of these kind of innovative solutions, we do face serious imbalances. If we look at the population pyramid and you look at the area above that black line, which is it's the number in the population over the age of 65, from 2004 going out to the middle of the century where it changes into the red area, you can see that dramatic growth in those over the age of 65. And at the top end, of course, a 6 or 7-fold increase in those over the age of 85, where the demand for long-term care is the most important. So if we're thinking about right now we've got a pool of 65 to 74-year-olds, and it's a growing pool, and it's an insurance opportunity, but we're already into the baby boom retirement. We're already several years into that, and we're missing the boat. And I would argue that we're missing it at our peril. So that's my contribution to the annuities debate.